So we are Group F who will present the result of research on how exchange, interest, inflation rate, production index influence international trade. Group F team members include Ridho, Sehee, Diana, and me. Our presentation are introduction, literature review, data and methodology, finding and conclusion. First, the background of our study. This is the background knowledge of Malaysia and Singapore, which is the focus of our research. Malaysia economy is the fourth largest in Southeast Asia and the 36th largest in the world. In addition, Malaysia economy is the 27th most competitive country in the world, according to the World Competitiveness Report. Next is Singapore. Singapore is a country that began to dominate foreign companies and capital and grew rapidly from the mid-1960s to the 1970s, achieving double-digit economic growth. As such, both Malaysia and Singapore are among the world's most promising emerging economies. Next, I'd like to talk about why we are doing research on the topic, the problem statement. International trade is an important contributor to Malaysia economic growth and development. Singapore is also one of Malaysia's major import and export partners. However, international trade between Malaysia and Singapore has been falling sharply in recent years. Therefore, we wanted to study what factors influence the sharp decline in international trade in Malaysia and Singapore in recent years. So we consider four factors in the study: exchange rate, inflation rate, international rate, and the IPI. Finally, I would like to talk about the purpose of our research. The purpose of our study is to explore the relationship between the change in the ratio of independent and dependent variables, and then to identify the determinant that affect international trade between the two countries based on the content.
Hello, I'm Sehee. Now let me review the literature we found. The first is about exchange rate and import and export. Anita and four others analyzed that the exchange rate and import and export relationship have a significant correlation. In conclusion, as the exchange rate and export are positive relationship and the exchange rate and import are negative relationship. However, some papers are skeptical of this view. Wilson and Kwa and the other two documents state that there was no significant influence between exchange rate and import and export. According to a survey by Young, it is worth analyzing how exchange rate fluctuation in Malaysia, Singapore affect each country because Malaysia and Singapore say they have close economy exchange. That's the next slide, please. Yes. The second is the literature on interest rate and import and export. In general, many economists say that rising interest rate reduce export and increase import. Therefore, the central bank periodically change interest rate to exert influence on the market. A literature review study by scholar Choi Byung-il also revealed that higher interest rate weaken export price competitiveness. Since Singapore and Malaysia are intertwined with economic policies such as AEC and RCEP, it is necessary to analyze how and how much interest rate fluctuation affect each country. Next slide, please. The third is the literature on inflation and export and import. This one and Choi Byung-il show that if inflation continue, export decreased and import increased. A study by Miguel and Diwan also said that there is a significant causal relationship between inflation and import and export, and that it is made in one direction. How inflation in Malaysia and Singapore affected export and import from each country will be discussed later. Next slide, please. Lastly, the literature on productivity and import and export. It was difficult to find data related to our research here because they use productivity indicator different from ours. But one thing in common is that as export increased, productivity indicator also increased. However, it does not deal with production line and import. ABAC has conducted a study that import increased as IPI increased. However, it was analyzed as a productivity indicator within Turkey. We will analyze this, what influence the two countries exert on each other with their IPI. Thank you.
Hi, my name is Lau Hui Yin, matrix number A175520. I will present the data and the methodology. First, about the data collections. Our group chose to use secondary data in this study for efficiencies and speed resulting from the use of existing resource. The source of secondary data that we use is World Bank data and Department of Statistics Malaysia data. The data used in this study have been divided into two variables, which is independent variables and dependence variable. The independent variables are the foreign exchange rate, inflation rate, interest rate, industrial production index for each country. For foreign exchange rate, we use local currency units per US dollar as a measuring unit. We use the overnight rates as a measure of interest rate to avoid negative figure when processing the data through statistics. The data of inflation rate is measured by the change in the consumer price index CPI, which reflects the average rate of increase in the price of a basket of goods and service. We use the best year 2019 equal 100 as the measuring variable for inflation rate and industrial production index for two countries. The dependence variable are Malaysia import and export from or to Singapore, and the measuring units is in Malaysia ringgit millions. All the data are taken from January 2015 and until April 2022 on a marine basis. Next slide, please. All the data are processed and analyzed by using econometric software called econometric views. E-views. Table 1 shows the result of unit root tests, while Table 2 shows the data used for regressions and parallel squares causality. Next slide, please. This slide is showing the abbreviations used in this paper research. That's all from me. Next, I pass to Ridho.
Thank you. Now we are heading to the descriptive statistics. Next slide, please. The descriptive statistics give an insight that the Malaysian export is symmetrical, unlike the Malaysian import, which is illustrated by the probability figure. Between the Malaysian variables, it is the CPI that has the most fluctuations, while it is the Singapore's IPI that fluctuates the most between all Singapore's variables, which is illustrated by the standard deviation figures. Next. The time series graphs explain the upward trends in CPI and IPI in both countries. While Malaysian IPI had a significant drop just prior to the COVID-19, while Singapore's IPI also having an upward trend but equipped with higher volatility. In regards to the interest rate on both countries, there is a significant drop in the beginning of 2020 due to the COVID-19 and the slowdown of the global economy, which stimulates the central bank to have an easing policy. The low levels of interest rates on both countries remain until 2022, which put the consequences on the wildly rising CPI, particularly seen in Singapore. Next. So we examine the data through coefficient correlation to find out the correlation between the variables. On this test, we look through the relationship between the independent and dependent variables. It is apparent that Malaysian's IPI and CPI, as well as Singaporean IPI and CPI, have significant positive correlation with Malaysian export, while Malaysian interest rate inversely correlated with Malaysian export. The pattern is also similar for Malaysian import, where the figure correlates heavily with both countries' IPI and CPI. Next. Through the regression analysis, we found that Singapore IPI and Malaysian CPI positively correlates with Malaysian export, with the fact that Malaysian CPI correlates much more significantly than Singaporean IPI, illustrated by a significantly higher figure of the coefficient. On the other hand, Malaysian interest rate correlates negatively with Malaysian export in a moderate strength. This strengthened the finding on the previous coefficient correlation analysis. On the other side, Malaysian import from Singapore is shown to have a positive correlation with Malaysian interest rate and Malaysian IPI, while there is no Singaporean variables that correlates with Malaysian import according to this regression analysis. Next. Through pairwise Granger causality, we found out that Singaporean interest rate, CPI and IPI have a long-term causality with Malaysian export, with Singaporean IPI having the strongest causality between the three variables. Furthermore, there is a long-term causality on Singapore CPI and IPI towards Malaysian import, with Singapore CPI has the strongest causality. Next. We did the co-integration test between the variables used in this research. It is found that there are 4 co-integrations. These findings suggest that the strengthening integration between the examined variables of this research. Furthermore, the result from trace co-integration test as well as the maximum eigenvalue co-integration test leads to the implementation of VEC Granger causality below instead of VAR. And through this VEC Granger causality, we obtain an insight that there are no independent variables that have a cause and effect relationship towards Malaysian export, while Malaysian import is affected quite significantly by Malaysian CPI. Next. In conclusion, we can digest that from the analysis that the export and import of Malaysia are relatively influenced by the similar indicators. We found that although the exchange rate on those two countries have a correlation with both export and import through coefficient correlation analysis, the trend does not continue through regressions as well as both Granger causality, which illustrates the absence of strong causality between exchange rate and export and import. On the other hand, it is the CPI and IPI which heavily influence both export and import based on our analysis. For CPI in both countries, it influenced both export and import on the same level, while for Singapore CPI, it illustrates a stronger causality effect with both export and import by the Granger causality test. Malaysian CPI appears to have a stronger correlation with export and import through regression and coefficient correlation, but it is not apparent through the Granger causality test. On the other hand, for both countries' IPI, they also have a significant correlation with export and import, but our findings suggest that Singapore's IPI influenced Malaysia's exports more than Malaysia's import, while Malaysia's IPI influenced Malaysia's imports more than Malaysia's exports. We find that this result is a little bit counterintuitive at first glance, asking why the increase of IPI in one country affects the inflow trade from its counterparty more than its own outflow trade to its counterparty. It can be analyzed if IPI can illustrate productivity, then it means an increase in IPI illustrates an increase in productivity. If an economy has an increasing number of productivity, then it means that the economy has more capacity to produce more goods or services, or even both. The higher productivity of the economy brings up the buying power of the people, and the higher buying power of the people ignites more consumptions, not just from the country, but also from another country. This trend is seen to be the logical flow of why the increase of IPI in one country affects the trade outflow of its counterparty trade. In regards to the interest rate, it is acknowledged that the Malaysian export does not correlate with both Malaysian interest rate or Singapore's interest rate, while Malaysian export has a negative correlation with Malaysian interest rate. This findings is in line with Choi Byung-il, 2018, who stated that the rising value of a country's currency, which can be ignited by the increase in the interest rate, will reduce the competitiveness of international trade of that particular country. I think that's it from all of us. Thank you.